Yeah, welcome, ladies and gentlemen. It's already 3 o'clock, and we are waiting now until our participants are moving into this virtual roadshow with Caledonia Mining. You see already Mark Learmonth here in front of me. Mark, welcome, and hello to Josie, where you are based at home, right?
Yeah, I'm here in Jersey. It's a lovely, lovely warm day. It's very nice indeed.
Super. Yeah, same here in Switzerland. We have like, I think almost 28 degrees outside. So I'm quite happy with my fan here in the office, which is quite good. Yeah, until we are waiting, we have now 62 people registered, already 30 are in. While we are waiting here for the rest to check in, maybe Mark, can you give us your short opinion on gold and the gold market itself, as you are one of the largest gold producers in Zimbabwe?
Yeah, we're very positive, gold. I mean, underpinned by any sort of metric you can think of. I mean, printing of money or electronic money by the various central banks, over borrowing, and then on top of that, some really quite uncertain sort of geopolitical things. You know, we've got China revving up in the east. You've got a highly unpredictable American president, and you've got Russia. So I think everything points, everything is pointing towards a dash for more security, and frankly, gold's where it is. So I can comfortably see gold moving up to $2,000 an ounce, which is, I think, a recent forecast put out by Goldman Sachs. I can comfortably see it getting there. But I've always said that when people say, "Oh, gold's going to go to $3,000, $4,000," I've always said to people, be very careful about that, because if gold goes to $4,000, what's happened to the rest of the world? So
yeah,
look, we don't need gold at $2,000. We make plenty of money at gold substantially lower than the current gold price. But I can just see a steady move into gold, and I can see the gold price moving up. And I'm hopeful it goes up and stays up. And I don't really want to see a short-term spike.
Okay, fantastic. Yeah, I think with 4,000 or 5,000 dollar gold, you probably need a gun when you go for shopping. That might be possible. We don't know. Okay, so it looks like that we had enough time here. So we have 34 people already in, still some checking in, but I think we should start for those who are waiting. Yeah, welcome, ladies and gentlemen, to our virtual roadshow today with Caledonia Mining. And here with us is Mark Learmonth, the CEO of the company. And we are really happy to share his thoughts here and to really get the knowledge about what's going on in Zimbabwe, what's going on with their successful gold production at low costs, and what are the next steps of the company. My name is Jochen Steiger. I'm the founder and CEO of Swiss Resource Capital, and also the founder and chief editor of Rohstoff-TV and Commodity TV, as most of you know me, of course, but for those who are new. And we will start now in a second with the presentation. Let me say you something before in advance. We are fulfilling all rules and regulations with the DSVGO law in Germany, also in Switzerland, and European Security Data Law. Nobody can see each other, and also all emails are locked and all names are locked. And please use the chat function. You find it in the gray bar, and to pose some questions, which we will then talk about after the presentation Mark gave us. So I will put up the slideshow now. And Mark, I would say the floor is yours. Please give us an insight into your terrific company. Thank you.
Good afternoon. Well, I don't know how many of you have seen this presentation before. We do come through Switzerland and Germany quite often. So I'm going to assume that people don't know this story. Moving through the disclaimer, this presentation has really got three elements to it. The first is to spend some time just informing and reminding you of the solid foundation we've built at Caledonia Mining over the course of the last 5 years or so. And that should give you a certain degree of comfort that we have a business of substance and scale. The second thing is to remind you or let you know that we have some very near-term, very low-risk investment project, a big investment project, where we are now just basically a few months away from harvesting the last 5 years of investment. And then the final thing I'd leave you with is to make sure that you're aware of the very attractive new investment opportunities. And we can see Blanket Mine, once we finish the Central Shaft project, as providing a fantastic springboard for some really quite exciting investments in Zimbabwe. So just dealing with the first of those, the building the solid foundation. Here you have an overview of the company. We're an established gold producer. Our asset is the Blanket Gold Mine, which is in Gwanda in the south of Zimbabwe. That's been running for well over 100 years now. We're a Jersey company, Jersey in the Channel Islands. Until last week, we were listed on NYSE, the Toronto Exchange, and AIM. We closed down the Toronto Exchange last Friday. The reason for that is simply to push liquidity into the US market. One of the biggest obstacles investors tell us about when they want to buy shares and they're frustrated, they get very frustrated when there's insufficient liquidity to pick up meaningful blocks. And so we're very anxious to try and boost liquidity. And so the obvious place to do that is in New York. We cashed up. We had about $14 million of cash at the 24th of April. That's actually quite a high number because at that time we were earning money by selling gold, but we weren't actually spending any money because we were basically running out our stocks and we couldn't place supplier orders because South Africa and Zimbabwe were closed. And so during that period, our cash did escalate quite substantially. So the cash is still very good, but don't expect it to go up. 14 million was very strong cash. And we're on a P of about 7 on our adjusted annualized Q1 earnings. So we're by no means, even though our share price has done quite nicely, we're by no means overvalued. In terms of production, at the moment we're producing in the mid 50,000 ounces, so 55,000 ounces there or thereabouts last year, probably the same again this year, and then increasing to 75,000 ounces in 2021, and then sustainably 80,000 ounces a year thereafter until 2034. And quite a competitive cost per ounce. So we're looking at an all-in sustaining cost per ounce we say $700 to $800 an ounce. That's what's in the technical report that we published several years ago to support the investment in this new shaft. I suspect we'll be towards the bottom end of that. We have about 1.9 million ounces of gold. About half of that's in M&I, and about half of that's in inferred resources. The inferred resource grade is quite strong, as you'll see, and we have a very strong track record of converting inferred resources to M&I. So we do not feel in the slightest bit resource constrained, and as you'll see, we have very substantial further exploration potential at depth. And we're a dividend payer. We've been paying a dividend for many years now. We started to increase the dividend in January this year, so we increased it by about 9% from 6 7/8 cents per share per quarter. It's now running at 7.5 cents per share per quarter. It's fair to say that the impact of coronavirus has made us a little bit more conservative about the rate of dividend increases. So in the ordinary course of events, I would have expected to continue to increase the dividend, but I suspect that's just a temporary phenomenon. And certainly the underlying business is strong, and as we continue to move forwards and increase production, reduce costs, boost cash generation, I have every expectation that the dividend will continue to increase quite substantially. Just give us some data here which you can peruse at your leisure. This is a remarkably dull slide, but you can see the gold production, we've increased it. It's now hovering around the mid 50,000 ounces a year. Operating cash flow is very strong, $23 million in 2016, and it's been $20 million there or thereabouts ever since. But we are spending a lot. We're spending about $20 million on capex. And I'll explain that in a moment. But the underlying engine of the business, the cash generation of this business already is very strong. Notwithstanding, that's even before we take account of the increased production and, of course, the higher gold price. We've had some positive news flow in recent months, culmination of a lot of strategic developments. So about this time last year, we'd finished sinking the central shaft. The electricity situation in Zimbabwe stabilized. We've increased our dividend. We achieved record production in Q4 of 2019. We've increased our stake in Blanket Mine from 49% to 64%. So there's a steady series of good news flow, which has been reflected by a very strong performance in the share price, which you can see here. Now, this clearly is the share price which we benchmark against the GDXJ. Obviously, it doesn't show last night's temporary, what I believe is a very temporary correction, but our share price has substantially outperformed the other gold producers, other small gold producers in the last 9 months or so. And I think that really reflects the fact that the market is now actually beginning to believe the story that I've been saying for 5 years, which is that we really are in the business of increasing production at this mine in Zimbabwe, massively increasing our cash generation, and we're beginning to demonstrate that we're prepared to share the benefit of that cash with shareholders. I can perhaps come back to the events of last night in New York, but we think that was driven largely selling by Canadian retail investors who don't like the fact that the Canadian exchange, the Canadian listing has been terminated, and aren't prepared to trade in New York. We see that as a temporary phenomenon, and I'd expect the share price to recover when New York reopens very shortly. Here's a bit about the resource base. So we've had several years of continuous annual improvements in the resource. It's fair to say that in 2010, 11, 12, we didn't really devote much effort to exploration. The situation in Zimbabwe was quite unstable at that point, and we just didn't see the point in investing money today to prove up resources which would exploit in 10 years' time. Since sort of 2014, we've changed that approach. We have continued to invest in exploration, and I think our discovery cost is something like $4. So it's about $4.40 per ounce. So there's plenty of gold there, and we're quite good at finding it at a very cheap price. We would probably do a new resource upgrade update any month now. I know the guys are working on it, and we expect to see a continuation. So we do not see ourselves as resource constrained. And I think what's important is that the inferred grade at 4.52 grams a ton is quite significantly higher than the M&I grade. And so we're not putting stuff into inventory that will never ever be commercially accessible. And you'll see in a minute, as we take the mine deeper, we think we've got substantial exploration targets at depth. Here's just a few words about the dividend. I mean, this just really tells you we've been paying a dividend since 2012. Initially, we paid it in annual dividends because we didn't really know what we were doing at that time. We just thought we got an awful lot of money, let's give it back to people. And then we realized it was probably cleverer if we paid it on a quarterly basis, so that we were more regularly in investors' faces in terms of sending them money. Initially, the dividend was denominated in Canadian dollars, because at that time we're a Canadian company. But then as the Canadian dollar kept on devaluing, that was become worth less and less in US dollar terms. So then we converted it to a US dollar dividend. Then we moved out of Canada, moved the company out of Canada to Jersey, which meant that non-Canadian shareholders no longer suffered Canadian withholding tax, which is also for those investors represented a further increase in the dividend. And right towards the end of last year, well, in January this year, we increased the dividend in real terms very slightly from 6 7/8 US cents a quarter to 7.5. And as you'll see, it's a key part of our strategy to continue to have a series of dividend increases as the business continues to improve. But I'll come on to that later. So here's that should give you some comfort that the business we have already today is performing well, produces lots of gold, is highly competitive and very cash generative. This now is the Central Shaft project, which we've been working on for about five years now. And what we're doing is we're building a 6-meter diameter 4-compartment shaft, which goes from surface to 1,200 meters below surface. And effectively, what we're doing here is we're building a new shaft underneath a new mine underneath the old mining operations. So the shaft was finished in July last year, and we're now busy equipping it. It's fair to say the equipping phase has been very slightly adversely affected by the effects of coronavirus. We've not been able to move some of the key contractors up from South Africa to Zimbabwe as we would have wanted to, but it's too early at this stage to say that the project will be delayed. So the delays so far are within the tolerances that we've built into the planning process. And so on this basis, we expect to finish the shaft towards the end of this year. And this is what we're doing. This is the long section of the mine. So the bits in red, that is the new infrastructure that we're putting in place. So you can see the central shaft going down from surface to 1.2 kilometers. And then from there, we'll do horizontal development on 3 levels in 2 directions. And then many years later, we will also then put in some decline developments to open up a new level below the bottom of the mine, below 1,200 meters. But that's many years away yet. The footprint you see here, it's about 3 kilometers from left to right, and we exploit about half a dozen nearly vertical ore bodies. And you can all the bits that are there in dark grey. Those are the areas that have been now fully exploited. As I say, the mine's been running since 1905, 1906, something like that. So, you know, this mine's over 100 years old, and it's inevitable that certain areas will now have been fully exploited. At the moment, when we started this central shaft project in sort of early 2015, the bottom level of operation was 750 meters below surface, and the infrastructure that we used to exploit that's shown in green. So that's the number 4 shaft, the horizontal development, mainly to the left in green. And you can see that really didn't leave us with an awful lot of resources and material to play with. And so frankly, we had no choice. We have to go down deeper. And below 750 meters, you can see those dangly bits, those sort of lighter areas. That's measured and indicated and inferred resource. And as we take the mine deeper, we're very confident that we'll have now the flexibility to do more drilling, so that we can upgrade the existing inferred resource to M&I, and also do further drilling at depth. These ore bodies are not constrained by depth, and so we're very confident that as we do deeper drilling, we can chase these ore resources further down. So the current life of mine's out to 2034. And we've got every confidence that with further exploration, we can extend that by several decades. So these pictures just give you some indication of the sort of size and scale of what we're doing. You know, these are proper big haulages, built straight, wide, built for speed. This will be a proper first world operation. And this really boils the whole thing down to numbers. This picture here is somewhat fussy, I'm afraid, and that's to comply with Canadian reporting requirements, which don't allow us to paint a picture which amalgamates production from measured and indicated resources and also from inferred resources. So what you see here is the historic data. That's the sort of this half a dozen the grouping of half a dozen bars to the left-hand side. That is taken from our accounts. It shows the operating cash flow per year. That's the lighter grey bar. Then the dark bar, that is the capital expenditure per annum. And you can see that we've been making $16, $23 million, $22 million, $25 million, and then $28 million of operating cash flow. But we've been spending anything between $18 and $20 million. So a significant proportion of the substantial cash we've been making has gone in capital expenditure. And of that capital expenditure, there's about 4 million is sustaining, and the balance is in the growth project. Now, as you go forwards from 2020 onwards, what happens is that the operating cash flows increase as production increases and as the on-mine costs come down. So 2020, we're looking at cash flow of about $30 million, but CapEx begins to fall away quite quickly. And so the gap between the operating cash flow and the CapEx, that delta, that free cash flow delta, begins to increase very, very substantially. And all of these projections were done many years ago using a gold price of $1,214 an ounce. So clearly the amount of free cash that we're showing here, $20 million in 2020, $29 million in 2021, $30 million in 2022, they increase very substantially just by virtue of the fact that the gold price is much higher. Now, going forwards from 2023 onwards, we pretty much expect that what you see in 2022 will continue out for the following 12 years, but we can't actually show that in this chart because that production will largely come from inferred resources. So I'm afraid that's quite a long and involved discussion around what really is what we believe is a very compelling chart, which shows that after 5 years of quite substantial investment, we're now on the cusp of realizing that investment, and that will generate very, very substantially increased cash flows. And I suppose the question then is, what do we do with those cash flows, which I'm going to come on to in a moment. I think you need to be aware of the new opportunity, of the new investment opportunities in Zimbabwe. It's fair to say that until the 80s, Zimbabwe was Africa's third biggest gold producing country after South Africa and Ghana. The gold resources are pretty much spread in sort of 4 areas: towards the south, where we are, Gwanda area, then a little bit further north, they're clustered around Bulawayo. In the Midlands, they're around Gweru, and then towards the north around Harare. And all of those green areas, if you were to amalgamate all those green areas, that creates an area which is about the same size as Mali today. So if you put together all of these sort of gold prospective regions in Zimbabwe, you're looking at an area which is very, very substantial. Okay, so don't for a minute write Zimbabwe off as being devoid of geological potential. It's got fantastic geological potential, particularly for gold. It's just that over the last 30 years or so, there's been virtually no exploration spending there. If you, just moving on, the sorts of things we're looking at, I think we need to be clear on that. I can tell you we are not thinking of buying big, hairy, producing assets which have had bad investment decisions over the decades and have been undercapitalized and would cost many tens of millions of dollars just to fix them. We're not going to throw our money to try and fix other people's mistakes. Okay, so typically we're looking at brownfield projects where there has been some that there may be some existing small scale operations, possibly artisanal operations, or perhaps just small scale commercial family owned operations with a very modest initial acquisition cost, say a couple of $1 million here or there, and perhaps a very small resource base, but with significant resource potential. The objective, having got our hands on these assets, is to do 2 or 3 years of drilling to identify a significant resource which is compliant, so we can talk about it, and then develop them from there. In the short term, it may be that we also engage in some relatively modest short-term production opportunities, say from sulfides or from shallow oxide material or retreating tailings dumps. But that's really just to show everybody, show the government, show shareholders, and show the local communities that we're in the business of generating gold. We don't really seem to be sitting on assets. And our evaluation criteria are quite strict. They must be big enough. They must be big enough to support a meaningful operation. So typically that means that we'll be looking for things that can sustain. They'll have at least 1 million ounces of resource and could sustain target production of at least 50,000 ounces a year. Much below 50,000 ounces of gold a year, frankly, you have diseconomies of scale. They're just too expensive to run. And I'm a shareholder, and I know that if we do nothing, if we don't do any of these new investment opportunities, if we just simply harvest the cash that's going to come out of the business when we finish the central shaft, I know that I could afford to increase the dividend from the current rate of about 30 cents a year. We could increase it to well over $2 a year. Okay, so I know that doing nothing, I can enjoy a substantial increase in the dividend from 30 cents to $2. If I'm going to do any of these new opportunities, I need to know that the amount I can expect to receive per share in due course will be higher than if I do nothing. Otherwise, there's no point in doing it. So we're very, very focused when we evaluate new properties that it must, in due course, so there may be a period of investment, in due course, allow us to increase the payout to shareholders so that it's higher than it would be if we do nothing. I think that's a fairly clear, it's quite a verbose way of explaining how we go about it, but we're not in the business of chasing ounces just to become a 250,000 ounce a year or 400,000 ounce a year producer. It's got to actually add money, add cash. So I think that's the investment case. It's quite straightforward. So we've got a strong track record. We are a robust operator. We work in a difficult jurisdiction, but we've been operating successfully there for many years now, and I can talk about that in more detail if someone wants to talk about it. After 6 years of heavy investment, we're now within a matter of months of beginning to harvest that investment, which will see a very substantial increase in our cash generation. We did have an attractive dividend yield before the share price ran ahead, but we do have scope to increase the dividend quite significantly. And I think we've demonstrated over the course of the last 5 years our commitment to using the dividend as a tool to reward shareholders. And underpinning all of this, we think Zimbabwe is a very, very attractive investment opportunity. And we are best positioned in country to mobilize the expertise and the cash to hopefully take this business from 80,000 ounces a year up to, in my mind, I target 500,000 ounces a year. So I think that's the end of the formal presentation. There is some research available. So if there's research available from WH Ireland in the UK and also from Cantor Fitzgerald, that's in North America. But with that, I'll take it over for any questions or discussion, Joachim.
Fantastic, Mike. Thank you very much. So I stopped the presentation here. That was very compelling and really fast. Great. Yeah, it looks like that the company is in a perfect shape, especially with the $14 million in cash. And by the way, you do not have any debt, right?
We've only got local working capital borrowings, and the problem is that because they're in local currency, they keep on evaporating in front of your eyes. So no, we actually would like more local working capital facilities to make our balance. So no, we're ungeared.
Great. Okie dokie. Then let's start with some first questions here, which I see. Christopher is asking, would you be buying some high-tech drilling machines to help the drilling, meaning overall, or more in a broader sense spoken, what techniques are you using? Are you putting more onto manpower, or do you have a nice mixture out of the machinery and toolery you are using underground?
Jeez, that's a very technical.
Yeah.
I'm not. Look, I just count the bloody money. I'm not a geologist. But I think underground we use the best available equipment we can procure in South Africa. So we get good quality South African underground drilling equipment. And then on the new properties, I guess we'll just be using standard diamond drilling techniques. We don't need to overcomplicate things in Zimbabwe. In fact, less complicated the better, please.
Okay. Then Paul is asking from Frankfurt, the mine is going now deeper and is deep now already. You're approaching, let's say, over a kilometer depth. And do you see any, let's say, risk of rising costs through that? Or is that already, let's say, calculated or included in your projections?
That's included in the projections. Sorry, can you hear me okay? Because I'm breaking up a little bit then.
No, it's okay.
No, we're very blessed. No, we're blessed because even when you get down to 1,200 meters, well, certainly I go down. I've been down underground down to 750 meters, and it's by no means hot. It's actually significantly cooler than, say, the London Underground on a day like today. So we're blessed by the fact that the rock is very old. So the rock, the ambient rock in which we're doing these activities is quite cool. Okay, so we don't need to spend money on refrigeration, unlike the deep level South African mines, and we won't need to do that at depth because the next door mine, which is very close to us, they're already I think they're down to about 1.5 kilometers, and they don't need to cool. So we don't need to cool the mine. We don't need to pump the mine significantly. We only really we take out about a third of the water that we need in the process. We pump from the mine, and actually we'd rather like it if we could pump more water from the mine. So it's a dry mine, and we're blessed by the fact that the rock is very competent. It's very hard rock, and so by and large we don't need to spend money on supports. Now, in certain areas where we're doing underhand stoping, for safety reasons, we do use support, but by and large, we don't need to use support on the haulages. And so, as the mine gets deeper, we don't expect a substantial increase in operating costs. There will be higher electricity costs, I guess, because we're hoisting from more depth. But in general terms, we would expect the cost per ton under the new mine to be lower than the existing cost per ton, because we'll introduce various efficiencies, particularly in the area of labour, where our labour will be used much more efficiently than it is at the moment.
Great. Johannes from Munich is asking that he heard that Rio Zim had to halt their production as the Central Bank of Zimbabwe did not pay for the delivery of gold. And then he says, as I know, the Central Bank only has the right to buy gold produced in Zimbabwe. Do you have similar experience or problems like Rio Zim? Or let's put it that way, what is your situation with the Central Bank in Zimbabwe, and how does it work, your gold sale? We
get paid. I mean, I was on the phone this morning to the finance team, and We get paid, and I know that Rio Zim have had a recurring difficulty with getting payments from the government, and I can't comment on why they should be struggling. We've never had a difficulty getting paid by the government. We sell our gold. We sell our gold to the government, and we've made it very clear to the Zimbabwe government that if they fail to pay us, it's quite simple. We won't deliver any more gold. End of story. Now they need our gold to earn the foreign exchange to keep the country running, but we've never had that difficulty. So all I can suggest is that it must be something to do with the way they approach the situation. Our receipts, the amounts due to us from the Zimbabwe government in respect of gold sales are absolutely within the normal terms and parameters. So it's not a problem we experience.
Okay, great. Can you maybe tell us a bit, because probably we had some people who came a bit later in. So once again, the share price rose by June 16th, and then it sank yesterday, of course. Yeah. So maybe you can again elaborate a bit what happened and what might be some reasons for that.
Yeah. So the gold price, our share price had run particularly hard, and I personally took advantage of that about 2 weeks ago and realized and sold a small number of shares, and I look forward to buying a very expensive German motor car with the proceeds. But I think what drove the trade in the events last night were we terminated the Toronto listing. So as of last Friday, so that would be Friday the 19th, that was the last day of trading in Toronto. And I suspect what happens is, even though we'd put out a press release 2 weeks before that to say what we were doing, I suspect that many people hadn't realized it or hadn't understood it. And so when they woke up on Monday morning and realized these shares are no longer traded on the Toronto Stock Exchange, I suspect many of them Canadians would have decided to sell their shares. Actually, there are only eight shareholders who hold something like 40,000 shares who are sitting directly on the Caledonia share register. All of the other shareholders, they hold through broker accounts, through nominee accounts. And so your broker can simply trade these, instead of trading these shares in Toronto, these shares can be traded tomorrow, the same day in New York. It's exactly the same piece of paper. They're completely fungible between New York and Toronto. So there's no reason why Canadians can't trade via New York. We terminated the Canadian listing for the reason that we want to encourage the Canadian trading on the Canadian Stock Exchange, Toronto Stock Exchange, which is actually relatively modest. We want to push that liquidity into New York, because the biggest difficulty that we hear from people who want to buy our shares is that our shares are too illiquid. The trading is too illiquid, and they can't buy meaningful stakes without materially moving the price. And so the objective was simply to take those 4,000 or 5,000 shares a day that are being traded in Canada and push it through the New York market to try and boost liquidity in New York. In due course, if we can identify that actually we have a very, very small number of Canadian shareholders, we will apply to deregister as a Canadian reporting issuer, in which case then we will only need to comply with reporting regulations in the United States and the United Kingdom. We won't need to comply with 3 sets of reporting, which is somewhat onerous. So I think that's what was going on yesterday. I don't think the New York market's probably just about to open, I think.
Yeah, you're 25% up. You're 25%
yeah,
up.
So we're confident it's a short-term phenomenon, and I can absolutely reassure anybody on this call, anybody on this listening to this, that there is no underlying problem with the business. The business is going exactly the same as it was, for the rest of the year. There's no difficulty at all, and so there's no reason, there's no underlying reason why those shares should have sold off. That's all I can say.
Great. Can we maybe come back to, let's say, the longer term projections you have done? Because I find it very interesting. First of all, how much money does your dividend cost today? Yeah, and we saw that you have now, much higher cash flow and profit projection in your presentation. So the point I'm making here is, what could we maybe expect? I know it's a forward-looking statement. Let's say for the development of the dividend within the next 2-3 years, while you have finished your central shaft and you put it in production, of course. Then.
Okay, the dividend is currently 30 cents a share
US.
per annum, split into quarterlies. And we've got about just less than 12 million shares in issue. We've got about 11.7 million shares in issue. So the dividend costs less than $4 million a year. Okay. And you can see from those numbers I showed you earlier, which were at a gold price, a much lower gold price than we're enjoying at the moment, our available cash for distribution would be something like $30 million a year. Now, clearly, if you use the higher gold price, it's substantially higher than that. So, as I say, we can easily increase the dividend to over $2 a share if we just simply spray all that money out to investors. But then we'll still be a 80,000 ounce a year gold producer with a single asset in Zimbabwe. And so, I would actually expect our yield, if we were to distribute $2 a share, I'd expect our yield to increase very significantly because we'll be X growth and seen to be a high risk investment. So the objective, my clear objective over the course of the next 2 years is to increase the dividend. All I can say is increase it significantly, in my mind, at least threefold. So I would like to take the dividend from say 30 cents to pick a number, say $1 a share over the course of a year. And then we'll still have plenty of money left behind to, as I outlined, to invest in new developments and commercialize new operations, which will then build in the future growth. Okay.
Okay. Then Herrick from Zook is asking, what a percentage are you owning now of your mine today? I think it's 64%, right?
64%. So we bought back 15% from a group of local Zimbabweans, and we actually bought that back and gave them Caledonia shares, because that group of Zimbabweans have actually been very helpful in terms of helping us navigate the bywaters of Zimbabwe, and they're people we want to keep involved in the business. And actually, we think they've got a contribution to make to Caledonia's broader growth. Okay, so we bought that back in January. Then 10% of the mine is held by workers, and 10% is held by the community. We're very clear. We actually value that direct participation in the mine, and we want to keep that in there. And actually, if we're going to develop any further mines in Zimbabwe, once the mines are up and running, we would do exactly the same thing. We would probably give 10% to the community, and we'd vendor finance 10% to the workers. 16% of Blanket Mine is held by the government. We've made numerous approaches to the government to buy that out for cash, because obviously we think it's a great investment. We'd like to increase our stake. And government's approach is always yes, we'd love to do it, but they find it very difficult to actually turn that into action. I suppose they're much better at taking assets off people than selling them back again, but they just don't seem to have the self-confidence or the internal capacity to actually do it. Everyone's too frightened to do anything. Nobody wants to be seen to be selling an asset, because if the price is wrong, then in 2 years' time they'll get nailed for corruption. So, frankly, to my mind, if the government doesn't come to the party very quickly, so said by the end of the year, I think we'll just accept the fact that we're in there for 16%, and we will treat them along. As we continue to take money out of Blanket, we'll simply pay them dividends, and we'll have a happy shareholder. Which isn't a bad place to be. One of the reasons why our access into government is as strong as it is because we pay good taxes, we pay good royalty, but to a small extent, government is benefiting from the dividends that Blanket pays out. And they can see that in 2 or 3 years' time, those dividends will increase very substantially, and that focuses their mind. And it means that they understand that if they do silly policies which affect the mine, they know it's going to hurt them.
Okay,
so it's a great place to be.
Yeah. Why is it, Henrik is also asking, why is it not possible to swap the mine into Caledonia? Of course, I think that's the law, right? This is why it's not possible.
So again, why is it possible not to
to put the mine completely into Caledonia? You know, now you have 64%.
We could do. No, we could do. No, so we could do that. As I say, that the law which requires local ownership has disappeared. So there is no legislative requirement for local ownership. Going forwards, we would, as I said, we doesn't matter what the law is. We actually get the benefit of having our workers in there and the community in there. That solves a lot of problems. If we were to look at any new projects, we certainly wouldn't be offering the government 16% of the mine. We do it ourselves. Okay, well, we don't want to buy out the workers and the community for Caledonia shares, because one day Caledonia is going to be doing other things in Zimbabwe. Okay, it's going to be doing different mines, and we think it's much more powerful to have the worker and the community focused on their asset, where they live and where they work, rather than actually have an interest in an asset that may be hundreds of miles away. So we actually that structure suits us quite well, actually.
Okay.
I'm not sure if I've answered that question.
No, that's exactly what I thought. No, that's exactly what I thought of, because I think also it makes much more sense, instead of giving them like a paper which they cannot really assess what it is. It's much better to have them directly inside the mine where they are working and living.
But if we gave them paper, we give them Caledonia paper, and the Caledonia paper has a value. You can see it every day. I think the other thing is, we as a matter of policy, a matter of principle, I would be uncomfortable having any government, not just the Zimbabwe, any government as a shareholder in my company. I just don't think governments should own shares in publicly listed companies. So it's not just the Zimbabwe. I wouldn't want the Swiss government. I wouldn't want the UK government. I don't want a bunch of politicians and bureaucrats sitting on our board and telling us what to do. That's more a political on my part. And I've got to say, that's not because it's a Zimbabwe government. Okay.
Yeah, okay, super. Question also from my side, because I remember we were talking last years about some satellite deposits around the Blanket mine. What's the status there? Could you imagine, for example, let's say, to use some of your free cash flow for speed up or advanced exploration? Sorry?
They were an inheritance. We inherited those from the previous chief executive. He thought they were a great idea. We've looked at them, and they're just too small. They're too small. They're never really going to add any value. They're going to absorb. It's just too small. It's play. It's play stuff. It's just it's inconsequential. It's irrelevant. And so I think we would probably seek to. We spent no money on them for many years. So I think actually the best thing for us to do would be to release them for people to whom they would be more relevant. They're just not relevant for us. They're too small.
Okay, great. So in your presentation, you referred to Zimbabwe as a great investment opportunity for additional project mines, etc. Could you also imagine, let's say, to go around Zimbabwe to your neighbor countries, or do you say, no, we are in Zimbabwe, this is what we understand, this is what we like the country, that's important for us?
Yeah. Okay, it's one of the things you've got to understand is that not all African countries are the same. Okay, so I've worked extensively in South Africa, Zambia, and Zimbabwe, and the way you approach those each of the governments and the way they behave and the way they think is very different. So, just operating in Zimbabwe gives you no credentials and no expertise in Zambia or South Africa. That's the first thing. Second thing is that I certainly wouldn't touch anything in South Africa. I don't think there's much of interest in Zambia from a gold perspective. Mozambique, they speak Portuguese, and my Portuguese is very poor. I'm not going to the Congo. I mean, there's no point in going from one high-risk jurisdiction to another high-risk jurisdiction. So I think, frankly, then the final thing is, we would find our relationship with the Zimbabwe government would deteriorate rapidly if they felt that we were taking money from a successful Zimbabwean mine and investing it in a Zambian mine.
Okay.
I think you'd find they might struggle. So I think what I'm saying is for the next 6 months at least, we've been trying to find assets in Zimbabwe for some time. We're making some progress. We'll maintain that focus on Zim. If by the end of this year or early next year, we just can't find stuff in Zim that we want, I think we've got no choice. We'll have to look elsewhere. So then the message to government is very clear that our preference would be to invest in Zimbabwe, but for whatever reason we can't, and therefore we've got to take our money elsewhere. One of the main impediments we face when it comes to finding assets in Zimbabwe is that the title, the legal ownership, the many good assets are trapped. Their ownership is trapped between two companies, neither of which has the financial capacity to do anything at all. But they both believe they own this piece of ground, and they're arguing about it, but they can't do anything with it.
Yep.
So frankly, that's a situation where the government has got to knock some heads together and actually tell people, and enforce use it or lose it, which I think is entirely the right thing for the government to do.
And that would be, of course, for you of big advantage. So that means for you, finally, that you see the political and also economic situation. Yes.
So let me be very clear. If the government invokes use it or lose it, we are not talking about some sweetheart deal with government. We would make if the government invokes use it or lose it, we would expect government to embark on a transparent, well-structured process such that the government gets someone coming in like us who's best placed to turn that to account. And we're confident that we can compete, with anybody else who might want to look at stuff in Zimbabwe. So we're certainly not looking for corrupt little side deals.
Yeah. Okay, super. How do you see overall the political and economical situation in Zimbabwe? Because I think, like in general, I think this is something what is really important for investors too.
Let's be very clear. Zimbabwe is economically in a very, very, very bad place. Inflation's running at high level. We've got no foreign exchange. There are people starving to death because the country can't afford to feed its own people. If you were running a business that required domestic demand, so like a brewer or a cement company or something like that, Zimbabwe would not be an attractive place to invest. But we don't need. We're a microcosm. We've got 1,500 employees. They live on our village. We can provide them with the stuff they need on the village. So proper water, electricity. We pay them partly in US dollars so they can afford to feed themselves. We're taking care of them in this coronavirus situation to protect them from any infections outside. Government recognizes that they need our business to survive, and to prosper and to thrive, because they need the gold revenues and the foreign exchange that we earn for the country and the taxes we pay and all that sort of stuff. So just because you mustn't read across from the difficulty that the Zimbabwean economy faces to our ability to operate successfully in Zimbabwe. It's a very challenging jurisdiction, but we work there because we do what the government needs us to do in terms of employing lots of people, paying lots of taxes, producing gold, earning foreign exchange. So we don't need, we import all of our electricity from the electricity system in Zimbabwe is broken, so we import what we need from South Africa. At the moment, we can import from South Africa, but if in due course the South African economy recovers and South Africa can't provide us enough electricity, we're very close now to implementing a solar project. And if the sun doesn't shine, we'll use diesel. Okay, so there's a lot we can do to protect ourselves from the economic chaos. Politically, the government has backed away very significantly now, in fact, completely, from the local ownership requirement. And that was the biggest single impediment to inward investment. And there is now no legal requirement and no commercial pressure at all to include government in new projects. And so that was the biggest impediment. And I think that's never going to come back, because the Zimbabweans now understand that it was indigenization and the land grabs that killed the agricultural sector and very nearly killed the mining sector. So I think they've got through a difficult place politically. So I wouldn't want to live there. Okay, it's a difficult place to live, but I'm happy working there I'm very happy working there and being a gold producer.
Fantastic. Johannes is also asking, the currency is fixed to the US dollar and I guess overvalued, he's saying. Does this negatively impact the operating costs for you? Or if you are paid for the gold in Zimbabwe dollar and not in US dollar, does this artificially bring down the gold price for you if you would not be able to change the currency to US dollars again for the official rate?
Can I just let my cat out? It's making a noise.
Sure.
That's a very good question.
It's a great question, Johannes. Thank you. Absolutely. So let's get the cat out here.
Let me answer. That's a very important question, which I need to answer without the cat here. So we deliver our gold to Fidelity in Harare. We get paid 70% of the value in US dollars. So that's fine. Okay. We get 30% of the value in local currency. And we get that 30% in local currency at the interbank rate, which is currently 25 to 1. Okay. So if we deliver like $1 million worth of gold to the government, to the refiner, we get $700,000 in US dollars, and we get $300,000 in local currency at the rate of 25 to 1. Okay. Now, the problem is that everyone knows the real exchange rate isn't 25 to 1. The real exchange rate is probably 75 to 1 or perhaps even 100 to 1. Okay. Now, what we do is we use that component we receive in local currency to pay our local bills at the rate of 25 to 1. Okay. So we pay taxes at 25 to 1. So we pay local taxes at the rate of 25 to 1. We pay some local suppliers at the rate of 25 to 1. And we pay a proportion of our workers, we pay 40% in US dollars and 60% in local currency. And that 60% in local currency at the rate of 25 to 1. Now, what that means is that we are simply passing down to our workers and our suppliers the fact that the exchange rate isn't a fair exchange rate. Okay. So it doesn't affect us, but in the long term, it will cause a problem if effectively our workers then say, well, thank you very much. I get paid 40% of my salary in US dollars, and that has a real value. I'm getting 60% in local currency, and that's got no value. So actually, I'm taking I'm only getting paid 40% of my salary. Now, that would become a problem if this thing continues too much further. What's happened recently, and I can tell you, every month we are short of local currency. Okay, so that 70-30 split, 70% in US dollars, 30% in local currency, that 30% in local currency isn't quite enough for us to cover our local currency denominated expenses. Okay, so if I was in a position where I was getting too much local currency and I just simply couldn't spend it, then I've got a problem, because now I'm going to be sitting with a growing pile of useless Zimbabwe money, which I've got no use for. Okay, that's not where we are. Now, where the government is, and we've been told that this fixed exchange rate is a temporary phenomenon. I think it was introduced at the end of, introduced in early April. So we've had several months of this now. The government has recently, in the last week or so, introduced some further reforms, trying to move this fixed exchange rate back to something that is more market related. And I think that they've initiated a series of auctions. I think the first auction is this afternoon, and I'm hopeful this fixed 25 to 1 exchange rate will now move towards something that is more market related. Okay.
Okay.
So
great.
it works for the time being.
Yeah.
For the time being, it works for them. But the Zimbabwe government has to be very careful, because the last time they went down this route in 2008, 2009, effectively it was the army who were being paid in worthless local currency, and it was the army that forced a change of government, and so the government knows that.
Okay, great. Halvar from Stockholm wants to know again, what are your largest shareholders? Meaning, for example, who is that sales promotion service?
Well, the biggest shareholder is Alan Gray, which is a fund management company based in Cape Town. So there was a man called Alan Gray. He passed away earlier on this year, but he left a massive South African institutional fund broker. They've got about 18%. Framiro owns about 7%. That's a consortium of three very helpful Zimbabweans, and there's a 6% or 7% is held by this sales promotion services. That is, as far as we understand, is held by an individual based in Vaduz in Liechtenstein.
Okay.
And then management, and we got no further information on him. Whether you believe he really owns it himself or whether you believe he owns it for somebody else, that's a matter that other people can speculate on. And then management own about 4% themselves. And those then you have a series of two or three two UK based institutions who just own just below 3%.
Okay, and the rest is then diversified, let's say, to retailers. Great, fantastic.
Yeah. So the retail.
Yeah, as I do not see any more questions here, and also from my side, I really must say all questions are answered. Anything you want to add at the end here? Aside of buy the stock?
Yeah, apart from buy the stock, no. Apart from buy the stock, I mean, people are buying the stock, and I think people are beginning to recognise that this story I've been peddling them for 5 years is now coming true. It's happening, and the proof of this will be when we significantly start to increase the dividend. And as I say, the only reason why we've not increased the dividend more aggressively is purely because of the impact of this coronavirus thing. You know, if heaven forbid we end up with a significant infection on the mine and we have to close the mine down for a period of weeks, you know, that's going to cost us money. And so we need to be a little bit more conservative in our approach to this. But other than that, we're absolutely flying, baby. Absolutely flying. And it's only the start, eh?
Fantastic. That was a great final word. Mark, thank you very much for a great presentation and also a great hour here of answering all those questions. I think you guys have done everything really right, and we look forward to the next dividend rise, of course. And I would say, very simply said, just keep it going, because you and the team are doing it fantastic. Thank you very much.
Thank you very much.
Thank you.
Thanks.
Yeah, ladies and gentlemen, that was our virtual roadshow with Caledonia Mining and Mark Learmonth, the CEO, who gave us a great insight into his terrific company. And yeah, we like it, of course. Well cashed up, production is running, investment in the future is done. The central shaft is now almost equipped, and they are really on the edge to start the production out of that. And also a lot of future potential, and we like the Zimbabwean approach. And as said, the company has done, and the management especially has done everything correct so far, and I think it's only a matter of probably 12 to 18 months is when we see really, again, a very nice jump in the dividend. They have the money to do that, and that's important for us also to be rewarded as a shareholder. So thank you very much that you have joined us here today. Mark, again, thanks to Jersey, and keep well. That's the most important thing. Guys, please stay healthy, and I hope that we can see us latest then in fall, again, also personally, but we keep you updated with our virtual roadshows, and I wish you all the best. Thank you very much. Bye-bye.